The S&P 500 might be walking into a trap, and most investors are completely blind to it. We're talking about a scenario where oil prices, geopolitical chaos, and a fragile equity market collide into something that could erase months of gains overnight. JPMorgan and Goldman Sachs, not exactly a pair of doom and gloom bloggers, have both warned that the S&P 500 could drop anywhere between 15 and 20% if oil prices stay elevated. Let that sink in for a second, because 15 to 20% isn't a dip, that's a crater. So why is oil the villain here? And why should you care? Think of oil as the hidden tax on everything when it rises. Corporate profit margins shrink, consumers pull back spending, and suddenly that earnings growth story the market was counting on starts to look a lot shakier. Add geopolitical conflict into the mix, and you've got a recipe for the kind of uncertainty that makes institutional money run for the exits. We've seen this movie before, in 2008, in 2020, and the opening scene always looks deceptively calm, right before the plot twist. Now here's where most people go wrong. They either panic sell everything, or they freeze like a deer in headlights, convincing themselves that this time will somehow be different. The smarter move, the one that actually preserves your wealth, is to rotate capital into something that barely flinches when markets throw a tantrum. Enter ultra short-term debt, specifically something like the iShares 0 to 3 month Treasury bond ETF, ticker SGOV, which holds short-term T-bills backed by the full faith and credit of the United States government. We're not talking about some exotic instrument cooked up in a Wall Street lab. These are the same boring, beautiful government IOUs that have anchored conservative portfolios for decades. Here's the mechanical genius of this thing. Because every holding matures in under 3 months, the fund has almost zero sensitivity to interest rate swings. Meaning, it doesn't care whether the Fed is hiking, cutting, or doing absolutely nothing. Since its 2020 inception, SGOV has never dropped more than 0.7%. In a world where the S&P 500 can sneeze and lose 3% before lunch, that stability is practically mythological. And let's be honest, there's a psychological tax that comes with watching your portfolio bleed red every time a headline drops about a pipeline, a conflict, or a central bank press conference. Moving a portion of your capital into something that quietly pays you every single month while the chaos unfolds isn't giving up, it's playing the long game with your sanity intact. The fund currently offers an SEC yield of 3.55% paid out monthly, which isn't gonna make you rich overnight, but it will absolutely keep your powder dry and your income flowing while you wait for clarity. And here's the elegant irony. The same Fed decisions that might be wrecking your stock portfolio are actually directly driving the yield on this instrument. So volatility becomes your ally instead of your enemy. Now, the yield isn't fixed. It moves with Federal Reserve rate decisions, which means when rates are high, your income is higher, and if the Fed cuts, you'll feel that in the monthly payout. But the principle? Rock solid. And in a world where preservation of capital is the name of the game, that stability is worth more than most people realize until they've already lost money chasing returns. History keeps rhyming here. Whether it's the oil shock of the 1970s, the Gulf War in the early 90s, or the pandemic chaos of 2020. Every cycle of geopolitical-driven market stress has rewarded the investors who stayed liquid and patient over the ones who doubled down on conviction alone. The lesson isn't that equities are bad. It's that position sizing and timing your risk exposure is a skill, not a personality trait. You don't have to abandon the market entirely. Nobody's saying to go full bunker mode with cash under the mattress, but shaving off a meaningful slice of your equity exposure and parking it somewhere that pays you to wait is a strategy, not a surrender. Discipline over drama, process over panic, and consistent small wins over the fantasy of perfectly timing the bottom. At the end of the day, the investors who sleep well during volatile markets aren't the ones who predicted every twist. They're the ones who built portfolios that could absorb the unexpected without requiring a miracle to recover. Sizing matters more than brilliance, and a steady monthly dividend from a government-backed fund while you watch the storm from dry land is a perfectly rational definition of winning. Whether the market corrects 15% or somehow shrugs it all off and rips higher, a well-positioned investor is comfortable with either outcome because they've already accounted for both possibilities. That's not pessimism, that's preparation. And preparation is the only edge that's always available to you, regardless of what the macro environment decides to do next. And if you're ready to take the next step, whether that's real estate investing, home contracting work, or finding the right lenders to fund your strategy, check out our links in the description below, because we're here to help you get started.